Have you ever been scrolling through the news maybe and you see a headline about the stock market going completely haywire?
Oh, definitely. Or you're just, hanging out and a friend starts talking about their portfolio or some IPO.
Exactly. And you're just nodding
Right.
along, right? But inside you're thinking, what on earth are they talking about? It feels like this whole finance world is like locked away.
It really does. Like you need some secret password or a special degree just to get it. And that feeling, that intimidation, it stops so many people. It stops them cold.
Well, that's why we're here today on the deep dive. We're not just unlocking that door. Nope. We're kicking it wide open for you.
Yeah, that feeling of being on the outside looking in, it's super common. But honestly, it doesn't have to be that confusing. It really doesn't.
And that brings us to why we're calling this deep dive Plebonomics. Plebs, for anyone wondering, is just Latin for common people. Simple as that. Our mission here is, well, pretty straightforward. We want to take stocks, something that sounds really complex, full of jargon, and just break it down. Make it clear, understandable, actually accessible for everyone, no matter your background.
We're cutting through all that Wall Street speak,
Mm-hmm.
the acronyms, the dense stuff. We want to give you the essentials, the things that actually matter.
So the big questions we're tackling are, what is a stock, really? Like, fundamentally?
Yeah, beyond just a ticker symbol on a screen.
How does it all actually work in the real world? And maybe the most important question, what does any of this actually mean for you, for your life, your financial future?
We've dug through a ton of material articles, basic text, you name it, pulled out the key nuggets, and we're ready to lay it all out.
Think of this as your shortcut. Getting informed without getting totally swamped. We're aiming for those aha moments.
Because understanding stocks
Yeah.
isn't just for fancy suits and skyscrapers. It's relevant for you, for everyone trying to navigate this economy.
Definitely. So let's dive in. Let's start right at the beginning. What even is a stock?
It's a great starting point because, yeah, it sounds simple, but pinning it down can be tricky.
Right.
So at its absolute core, a stock, and you might hear it called an equity or a share, they all mean basically the same thing. It's just a security, a piece of paper, or these days a digital record, that says you own a tiny fraction of a corporation.
A fraction.
Think of it like this. Imagine a big company, say a successful bakery, as one giant delicious pie.
Okay, I like pies. Keep going.
When you buy one share of stock in that bakery company, you're literally buying a small slice of that whole pie. You become a part owner,
Hmm.
a small one maybe, but a real owner nonetheless.
A piece of the pie. I like that. It makes it feel less abstract. So my slice size, it depends on how many slices there are in total.
Exactly. That's the fractional ownership part. It's
Right.
all proportional. So let's say our pie company, our bakery, has issued exactly 1,000 shares in total. That's all the shares that exist.
1,000 slices.
And you go out and buy 100 of those shares, well, you now own 100 out of 1,000, which means you own 10% of the shares of that company.
Right, 10%. Makes sense.
And owning those shares usually gives you a few things. It typically entitles you to a slice of the company's profits if they decide to share them.
Ah, the profits. The sweet filling of the pie.
Exactly. And potentially a piece of the proceeds. If the company ever sells off all its assets, though, that usually only happens after they pay off everyone they owe money to first. Debts come first.
Okay, so owners are kind of at the back of the line there.
Often, yes. And it also usually gives you some voting power in how the company is run. But you said usually. So not always. Not all shares are identical.
That's a really sharp question. And no, they're not always identical. The sources make it clear. Companies can issue different classes of stock.
Classes, like first class in economy. Sort of.
Mhm.
Some classes might not come with any voting rights at all. Maybe they get paid dividends first, but they don't get a say in electing the board. Other classes might have extra voting rights. Maybe one share gets 10 votes. It really depends on how the company sets things up. Different classes can also have different rights to profits or assets if things go south.
Wow, okay, so it can get complicated. But for most regular folks, like me buying a few shares,
For most everyday investors, you're typically buying what's called common stock. And common stock usually comes with those voting rights we mentioned. One share, one vote is the standard setup.
got it. Common stock, equal voting rights usually. Okay, now here's something that I think confuses a lot of people. If I own a piece of the company, that slice of the pie, does that mean I can just walk into the company headquarters and start using their stuff?
Yeah, like, excuse me, I own 0.001% of this company. I need to borrow the CEO's stapler.
Right. Or demand a parking spot.
It's a great question because it hits on a really fundamental legal idea. the corporation as a legal person.
A legal person. Like, the company itself is treated as a person under the law.
Pretty much, yeah. When you buy shares, you don't directly own the company stuff, not the buildings, the computers, the delivery vans, none of that. The corporation, this separate legal entity, owns all of its own assets.
Ah, okay. So I don't own the chair. I own a piece of the thing that owns the chair.
You nailed it. You own shares in the legal entity. The entity owns the assets. This is called the separation of ownership and control.
Separation of ownership and control.
And this is super important because it leads to limited liability, which is a massive benefit for you, the shareholder.
Limited liability. That sounds good. What does it mean practically?
It means if the company gets into huge trouble, say, it goes bankrupt, owes billions of dollars, your personal assets are safe.
My house, my car, my savings.
All safe. A court can't come after your personal belongings to pay the company's debts. The most you can typically lose is the money you originally invested in buying the shares. Their value might go to zero, sure, but that's it.
Wow. Okay, that's huge. I mean, imagine if you could lose your house because some company you put a few bucks into went bust.
Nobody would invest.
No.
It would completely stifle everything. This limited liability was a massive innovation. It allows regular people to participate in capitalism, essentially, without risking absolute ruin.
And it works the other way, too, right? Like, if a big shareholder goes personally bankrupt.
Exactly. They can't just start selling off the company's factories or patents to pay their personal debts. The company's assets belong to the company. It protects both sides. It really is a cornerstone of how modern stock ownership works, a huge plus for the average person.
What's really wild is that this whole idea, sharing ownership, pooling resources, it feels so modern, so Wall Street, but it's actually ancient.
It really is. That fact alone kind of makes it less scary, I think. It's not some brand new alien concept.
So how far back are we talking?
Our sources point way back, even to the Roman Republic. They had these big government contractors called publicanae. Think of them as early corporations.
Romans had corporations.
Yeah.
Seriously.
Effectively, yeah. These publicani issued shares. Little ones were called particulae, bigger blocks were parts. And these things were traded. Prices went up and down.
No way.
Yeah, the famous orator Cicero even wrote about shares that had a very high price at that time. Partes illo tempore carissime. It shows they had fluctuating values, just like today. People were watching prices back then, too.
That's incredible. So people have been stressing about their share prices for millennia. Human nature doesn't change, huh?
Seems that way. And it wasn't just Rome. Fast forward a bit, around 1250, in Toulouse, France, there was a company called the Société des Moulins de Bazacle, a milling company.
Milling flour.
Yep. And guess what? They had shares, and those shares were traded based on how well the mills were doing, how profitable they were.
So the core idea, pooling money, sharing risk and reward, it's been around forever, just evolving.
Exactly. But the modern version, the joint stock company with shares, you can easily buy and sell on an exchange. That really kicks off later.
With like the big trading companies.
Precisely. Think of the English East India Company, chartered in 1600. And then, really crucially for our Plebonomics story, the Dutch East India Company in 1602.
What was special about the Dutch one?
They were the first ones to issue shares that were tradable on a proper stock exchange, the Amsterdam Stock Exchange. This was huge.
Ah, so not just private deals, but an open market where anyone could potentially buy in.
Exactly. That's the real beginning of the accessible stock markets we know today. It took this ancient idea and made it liquid, dynamic. When you see that long history, suddenly the New York Stock Exchange feels a little less intimidating, maybe?
Definitely less alien. Okay, so we know what stocks are. Ownership slices, ancient roots, limited liability, cool. But why do companies bother issuing them in the first place? What's in it for the company?
That's the flip side of the coin. And the main reason, it boils down to one word: capital.
Money.
They need cash.
Yeah.
They need cash. Lots of it, usually. They issue stock to raise money to fund big ideas, maybe build a new factory, launch a new product line, expand overseas.
Or maybe the founders just want to cash out some of their stake.
That happens too, yeah. Owners might want to diversify their own wealth or just get some liquidity. But primarily, for the company itself, it's about getting funds for growth without having to borrow it. This is called equity financing, selling ownership pieces instead of taking on debt.
And this is where we hear about the IPO, right? The initial public offering. That always sounds like a huge deal.
It is a massive milestone.
Yeah.
An IPO is when a company that was previously private sells its shares to the general public for the very first time, listing them on a stock exchange.
going public.
Exactly.
Yeah.
Suddenly, instead of just a few private owners or venture capitalists, they can tap into potentially millions of investors all over the world. It unlocks access to a giant pool of capital. Think about how companies like Google or Facebook got the billions they needed to grow so huge. The IPO was key.
So when they do an IPO or even issue more shares later, the existing owner's slice of the pie gets smaller proportionally. That's dilution, right?
That's dilution, yes. Each existing share represents a slightly smaller percentage of the now larger company. But the idea is that the money raised will make the entire pie much bigger and more valuable.
So a smaller percentage of a much bigger pie could still be worth more money.
That's the hope. It's a strategic trade-off. And sometimes companies do the opposite too. They buy back their own shares from the market.
Why would they do that?
It reduces the number of shares out there, so each remaining share represents a larger slice of the pie. It can boost the share price and signal that management thinks the stock is undervalued. It shows confidence.
Oh, okay, makes sense. Now, something that trips up so many people, myself included at first, is stocks versus bonds. They sound similar, both investments, but they're fundamentally different beasts, aren't they?
Totally different. And getting this difference is absolutely crucial for anyone, trying to manage their own money. It's foundational.
So break it down for us. Stock first.
Okay. Stock ownership. When you buy stock, you become a part owner, an equity holder. Your potential profit comes if the company does well, grows bigger, becomes more valuable, you share in the upside.
My tiny slice of the pie gets more valuable.
Right. Now, bonds loan. When you buy a bond, you are lending money to the company or government. You're a creditor, not an owner.
So I'm like the bank in this scenario.
Exactly like the bank. You lend them money, and they promise, legally, to pay you back regular interest payments over a set time, and then return your original loan amount, the principal, at the end.
Okay, owner versus lender. Got it. So why does this matter so much? Especially if things go wrong.
This is the key. The risk hierarchy. Think about what happens if the company hits really hard times, maybe even goes bankrupt.
Yeah. Who gets paid first from whatever's left?
The creditors, the lenders. That includes the bondholders. They have a legal priority claim on the company's assets. They get first dibs.
And the shareholders. The owners, like me with my stock.
You guys are last in line. Subordinate is the technical term. After everyone else, banks, suppliers, bondholders gets paid. If there's anything left, then the shareholders get a share.
And usually, there isn't much left, is there?
Often, especially for common stockholders, there's nothing. Zero. This makes stocks inherently riskier than bonds from that repayment standpoint.
So, higher potential reward with stocks if the company flies, but higher risk of losing everything if it crashes.
Precisely. Bonds offer more safety, that guaranteed income stream, usually, but typically much lower potential for growth compared to stocks.
That really shapes your choices then, doesn't it? Depends on your goals, how much risk you can handle.
Absolutely. Are you looking for growth over many years and can stomach the ups and downs? Stocks might make sense, need steady income now and want to preserve your capital above all else. Bonds might be more suitable. Understanding this difference is like step one in making smart investment choices for yourself.
Okay, so even within stocks, you mentioned it's not all the same. There are different flavors, common versus preferred. Let's unpack those.
Right. Got to know what kind of slice you're actually buying. Most of the time, when people talk about buying stocks, they mean common stock. That's the standard issue, the most common type.
So, common stock. What are the key features for the average Joe, the pleb investor?
Usually the big one is voting rights. Your common shares give you a vote in company matters, primarily electing the board of directors.
The board who then hires the CEO and oversees the company.
Exactly. So one share usually equals one vote. If you own a lot of shares, you have a lot of influence. Even with a few shares, you technically have a voice, even if it's a small one. It's how shareholders hold management accountable, at least in theory.
And what about getting paid? Do common stockholders get regular checks?
That's a key difference from bonds. Yep. Dividends, those profit payouts, are variable for common stock. And crucially, they're not guaranteed.
So the company decides if and when to pay.
Yep, based on how much profit they made, whether they need the cash to reinvest in the business, things like that. And if they do pay, common stockholders get paid after any preferred stockholders.
Okay, so less certainty on income. But the upside is?
The potential for capital appreciation. Common stock prices can potentially go up a lot more than preferred stock or bonds if the company is successful. But that also means their more volatile prices can swing up and down more dramatically. And like we said, last in line if the company liquidates.
Higher risk, higher potential reward, variable income, voting rights, that's common stock. So what about preferred stock? Sounds fancier.
It's kind of a hybrid, really. It blends features of both stocks and bonds.
How so?
Well, first, preferred stock usually doesn't come with voting rights. So you typically don't get a say in electing the board.
Okay, no vote. What's the trade-off?
The trade-off is usually about dividends. Preferred stockholders often have a right to receive dividends before common stockholders. And these dividends are often fixed at a certain level, much like bond interest payments.
Ah, so more predictable income, like a bond in that way.
Exactly. It provides a steadier income stream. And another bond-like feature. Preferred stockholders also have a higher claim on the company's assets if it liquidates. They get paid back after bondholders, but before common stockholders.
So safer in bankruptcy, too.
Generally, yes. And because of these features, preferred stock prices tend to be less volatile, less jumpy than common stock prices.
Interesting. Are there any other twists with preferred?
Sometimes you see something called convertible preferred stock. This gives the owner of the option, down the road, to convert their preferred shares into a fixed number of common shares.
So you can switch teams later if the common stock starts looking really good?
Kind of. It offers the initial safety and income of preferred, with the potential to jump into common stock if the company really takes off. It's a way to attract investors who want a bit of both worlds.
Okay, so preferred. Generally, no vote, fixed dividends, paid first. Higher liquidation priority, less volatile, maybe convertible. A different risk-reward profile.
Definitely. And beyond those two main types, investors sometimes classify stocks in other ways too, just to help categorize them, like growth stocks.
Growth stocks. I guess those are companies expected to grow fast.
Exactly. Companies whose earnings or revenue are expected to shoot up faster than the overall market. Think of, like, many tech companies, especially newer ones. They usually plow all their profits back into the business to fuel that growth.
So they probably don't pay much in dividends.
Often very little or none at all. You're betting on the stock price itself going way up, not on getting regular income checks.
Makes sense. And the opposite might be value stocks.
Right. Value stocks are companies that seem, well, undervalued by the market. Maybe they're in an unpopular industry right now or had a temporary setback. But when you look at their actual financials, their assets, their earnings, maybe they pay a decent dividend. They look cheap compared to their intrinsic worth.
So you're hoping the market eventually realizes it made a mistake and the price catches up, looking for a bargain?
That's the idea. Hunting for hidden gems the market has overlooked.
We also hear about large cap, mid cap, small cap. What's cap all about?
CAP is just short for market capitalization. It's basically the total value of all a company's shares added together. You find it by multiplying the current stock price by the total number of shares outstanding.
Okay, so a bigger company has a bigger market cap.
Generally, yes. Large cap companies, think Apple, Microsoft, the real giants, are typically worth billions, even trillions. They're usually seen as more stable, less risky, maybe slower growing.
And small cap.
Smaller companies may be worth a few hundred million up to a couple billion. They might have more room for explosive growth, but they're often riskier, more volatile. Mid caps are in between. These are just broad categories, and they shift over time.
Useful labels, though. And finally, sectors, like tech, healthcare, energy. Why does that grouping matter for an investor?
Understanding sectors is really important for diversification and understanding broader trends. Different parts of the economy do well at different times.
Like travel stocks might suffer in a pandemic, but maybe healthcare stocks do well.
Exactly. Or in a recession, people still need to buy food and pay utility bills, so consumer staples might hold up better than companies selling luxury goods, which fall under consumer discretionary. Knowing the sector helps you understand the forces acting on a company beyond its own specific performance. And crucially, you don't want all your investments in just one sector. If that sector hits a rough patch, your whole portfolio suffers. Spreading across sectors reduces that risk.
Diversification again. Seems like a recurring theme. Okay, so let's say I actually do it. I open an account, I buy some common stock. What rights do I really have? What do I get?
Okay, let's connect the dots on actual ownership. We mentioned the big one, the right to vote.
On electing the board of directors?
Primarily, yes. Your shares give you a say in choosing the people who are supposed to represent shareholder interests and oversee the management team, the CEO, and others who run the company day to day. It's your indirect influence.
Indirect, okay. What else do I get money?
You have the right to income, potentially, through dividends. If the company decides to distribute profits, you get your proportionate share based on how many shares you own.
Can you give a simple example?
Sure. Say a company has 1,000 shares out there total, and they announce, we're paying a total dividend of $5,000 this quarter.
Okay.
Well, $5,000 divided by 1,000 shares means each share gets $5. If you own 100 shares, you get a check for $500.
Nice. And some companies let you automatically reinvest that dividend money to buy more shares, right? DRIPs.
Exactly, dividend reinvestment plans. It's a great way to compound your investment automatically over time without having to do anything. Your dividends buy you more shares, which then earn more dividends, and so on.
Cool. Any other rights? What about new shares the company might issue?
Sometimes, yes, you might have what are called preemptive rights. This gives existing shareholders the first crack at buying any new shares the company issues, usually in proportion to their current ownership.
Why is that important?
It helps you maintain your ownership percentage. So if you own 10% now, preemptive rights help you keep that 10% stake, even if the company sells more shares, preventing your ownership from getting too diluted against your will.
Okay, maintains my slice size. And then the last one was assets in liquidation. Back of the line.
Yep, the right to assets in liquidation. It's a right, but it's subordinate. After all the debts are paid, after the preferred stockholders get their share, if anything is left, common stockholders get what remains, divided proportionally. But again, often there's nothing left.
Good to know the order. Now let's nail down some things you definitely don't get, because I think misconceptions linger. We hit the big one. No using company property.
Absolutely worth repeating. Owning shares, even millions of shares, does not mean you can use the company's buildings, drive its cars, or raid the office supply closet. The company is separate. It owns its stuff. Your relationship is purely financial ownership of the entity.
Not operational access. Got it. And that other huge one, limited liability. Say it again for the people in the back.
Happy to. Limited liability. If the company fails, goes bankrupt, faces massive lawsuits, your personal assets, your house, your car, your savings are safe. You are not personally responsible for the company's debts. Your maximum loss is capped at what you invest in the stock.
That is such a fundamental protection. It makes investing accessible to regular folks.
It really does. Without it, the whole system probably wouldn't work the way it does. Now, there's one more slightly nuanced concept our sources mention related to control. It's called the principal agent problem.
Principal agent. Sounds technical.
It basically means that while the managers and the board, the agents, are supposed to act in the best interests of the shareholders, the principals, their interests aren't always perfectly aligned, especially with small individual shareholders like most of us, what they call outside passive minority investors.
So the people running the show might have slightly different motivations sometimes than the average owner.
It can happen. Think about it. Management might want perks or bigger salaries, or maybe they focus on short-term results to boost their bonus, even if it's not the best long-term strategy for all owners. And while shareholders vote for the board, those elections are often, well, not very competitive. Usually the candidates are nominated by the current board or insiders.
So my one little vote, while technically there, doesn't always translate into massive direct influence on day-to-day stuff.
In practice, for most individuals, no. Your power comes more from choosing which companies to invest in, holding boards accountable collectively over time, maybe through larger funds, rather than dictating specifics. It's just the reality of how large corporations work. Good to be aware of it.
Definitely. Okay, solid grasp on what stocks are, why they exist, what ownership means. Now, the million-dollar question, literally sometimes. How do you actually make money? And why do prices jump around like crazy?
Right, the payoff. Generally, two main ways to make money. The most common one is capital appreciation.
Buy low, sell high.
That's the one. You buy a share at one price, hope the company does well or becomes more popular, the price goes up, and you sell it for more than you paid.
Give us another quick example.
Okay, say you buy a share of Tesla for $180. A year later, maybe it's trading at $250. You sell it. You've made $70 per share profit. That's your capital gain. Simple concept, but powerful over time.
And the second way, dividends again.
Yep, dividends. Those cash payments from company profits. Not all companies pay them, especially fast-growing ones that reinvest everything. But many established companies do, often quarterly. It's direct income into your pocket just for holding the stock.
So you can win by the price going up or by getting cash payouts or potentially both.
Exactly. And even if a company doesn't pay dividends because it's reinvesting profits, those are called retained earnings, that reinvestment should, in theory, help the company grow faster, which could lead to a higher stock price later. so you potentially benefit either way.
Okay, but why do the prices move? One day up 5%, next day down 3%. It feels random sometimes.
It can feel random, for
Yeah.
sure, but underneath it all, it's that fundamental economic principle, supply and demand.
How many people want to buy versus how many want to sell?
At any given moment, that's what sets the price. If way more people suddenly want to buy a stock than sell it at the current price, buyers have to offer a bit more to tempt sellers. The price edges up.
And if panic sets in and everyone wants to sell,
Sellers might have to accept lower and lower prices to find buyers. The price drops. It's like a constant auction. Millions of participants voting with their money every second the market is open, trying to find that equilibrium price where buyers and sellers agree.
so it's not just what the company is worth on paper, but what people think it's worth or will be worth. That sounds subjective.
It is hugely subjective. While the company's actual performance earnings, profit, sales, new products is a massive driver.
The fundamentals.
Right, the fundamentals. But so many other things sway that supply and demand balance. The overall economy is booming or heading for recession. Interest rates are they going up, making borrowing more expensive. Big news events, political changes.
All that external stuff matters.
Absolutely. And analysts forecasts what the experts predict for the company's future.
Even interestingly, customer satisfaction. Our sources mention studies showing companies with higher customer satisfaction scores, like the ACSI index, tend to have better stock performance over the long run.
Happy customers, happy stock price. Makes sense. But what about just people, being irrational?
Oh, that's a huge factor. Welcome to behavioral finance. It acknowledges that humans aren't always rational robots making calculated decisions. We're driven by fear, greed, herd mentality, overconfidence.
FOMO, fear of missing out.
Exactly. That can push prices way above or below what the fundamentals suggest. Think about the greater fool theory.
The what now? The idea that you buy an overpriced stock, not because you think it's worth it, but because you believe there's an even greater fool out there who will buy it from you later at an even higher, crazier price.
Wow. That sounds like musical chairs with money. Risky.
Extremely risky. It's pure speculation, detached from reality. And then you have the opposite theory, the efficient market hypothesis, which says prices reflect all known info almost instantly.
So it's hard to find bargains.
According to that theory, yes. New information is random, so price movements look like a random walk. The truth is likely somewhere in between. Markets are mostly efficient. But human behavior definitely creates bubbles and crashes sometimes.
So with all these ups and downs, what are the real risks for the everyday person investing in stocks?
Number one is definitely volatility. Prices can swing wildly, especially in the short term. You could be down 10% one month and up 15% the next. It can be an emotional roller coaster if you're not prepared.
That lack of stability is tough for some people.
It is. And that leads to the risk of loss of value. Just because you buy a stock doesn't mean it will go up, it can go down. You might have to sell for less than you paid, locking in a loss.
And the ultimate risk.
Company failure, bankruptcy. In that worst-case scenario, as we've said, common stockholders can and often do lose their entire investment. The shares become worthless.
Ouch. That's the big one. And you mentioned short selling earlier as super risky. Can you explain that simply?
Right, short selling. It's basically betting against the stock. You borrow shares from your broker, sell them on the market, hoping the price will drop. If it does, you buy the shares back cheaper, return them to the broker, and pocket the difference.
Sounds clever if you think a stock is overpriced. What's the catch?
The catch is potentially unlimited losses. If you buy a stock, the worst that can happen is it goes to zero, you lose 100%. If you short a stock and the price goes up instead of down, there's no theoretical limit to how high it can go. It could go up 200%, 500%, 1,000%, and you're on the hook to buy it back at that much higher price. Your losses can just keep mounting. Definitely not for beginners.
Yikes. Unlimited losses. Okay, duly noted. Avoid short selling unless you really know what you're doing. What about other risks? Quickly.
There's liquidity risk. Maybe you can't sell shares quickly without tanking the price, especially for smaller companies. And inflation risk. Even if your stock gains 5%, if inflation is 6%, you've actually lost purchasing power.
Lots to consider. Okay, so despite the risks, someone's listened, they're intrigued, they want to dip their toe in. How do they actually buy stock? Can't just walk into Apple and ask for a share, right?
No, not usually. Most buying and selling happens on stock exchanges like the NYSE or NASDAQ. And to access those, you typically need to open a brokerage account.
Like opening a bank account.
Very similar process, yeah.
Yeah.
You provide ID, some financial info, link your bank account to transfer money in and out. The brokerage account is where your investments, your stocks, maybe bonds or funds later, will actually be held electronically.
Are all brokers the same? How do I pick one?
Good question. Broadly, you have full-service brokers and discount brokers. Full-service ones offer lots of advice, research, maybe financial planning, but they usually charge higher fees or commissions per trade.
More hand-holding, higher cost.
Right. Discount brokers offer fewer frills, less advice, but their trading fees are much lower, sometimes even zero commission for stock trades these days.
DIY investing, lower cost.
Exactly. Your choice depends on how much help you want. If you want guidance, maybe full service. If you're comfortable doing your own research and want low costs, discount is probably the way to go. Look at fees, the platform's ease of use, research tools, customer service.
Can you ever bypass brokers? Buy directly from the company?
Sometimes, but it's less common for initial purchases.
Mm.
If you already own a share, some companies have direct stock purchase plans, DSPPs, or those dividend reinvestment plans, DRPs we mentioned, allowing direct buys. There are also things called direct public offerings, DPOs, but for most people starting out, a standard brokerage account is the easiest path.
Okay. Now what about buying on margin? Sounds like borrowing money.
It is borrowing money from your broker to buy more stock, using your existing investments as collateral. It magnifies your potential gains. It also magnifies your potential losses hugely. If the stocks drop in value, you can get a margin call, forcing you to add more cash or sell stocks at a loss to cover the loan. Plus, you pay interest on the borrowed money.
So like pouring gasoline on your investment fire could be great, could be disastrous.
Perfect analogy. Definitely something for beginners to be extremely wary of or just avoid altogether until they have a lot more experience.
Good advice. And selling is basically the reverse of buying through the broker.
Yep. Place a sell order, pay any transaction fee.
Yep.
And remember, if you sell for a profit, Uncle Sam will likely want a piece of that gain in the form of capital gains taxes. Factor that in.
Right, taxes, always taxes. Okay, so I'm set up. How should I approach this? Be a frantic trader or a patient investor? What's the difference?
This is a really fundamental mindset question. Traders are looking for short-term profits. Buying and selling quickly, maybe multiple times a day, trying to catch small price swings, trying to time the market.
Sounds stressful.
And time-consuming. Very much so. It requires constant attention, research, and a cool head under pressure. Investors, on the other hand, typically buy and hold. They're in it for the long haul, years, decades even. They focus on the company's long-term prospects and aren't usually rattled by daily price wiggles.
Which approach tends to work out better for the average person?
Historically, the evidence overwhelmingly favors long-term investing. Trying to time the market consistently is incredibly difficult, even for professionals. But if you just buy good companies or even a broad market index fund and hold on to the ups and downs, the long-term results have been pretty good.
You mentioned the S&P 500 average return earlier.
Yeah, around 10% per year historically before inflation, maybe 7–8% after inflation over long periods like 30 years. That kind of compounding growth is how real wealth is often built.
What does that look like in real dollars for someone starting small?
It's powerful. That example, $1,000 invested 30 years ago, just left alone in a broad stock market index, could be worth close to $8,000 today, purely from market growth. That's the magic of compounding over time. Patience pays off.
Wow. Okay. Long-term investing sounds more appealing, less stressful. Now that word again, diversification. Don't put all your eggs in one basket. Why is this hammered home so often?
Because it's probably the single best way for an average investor to manage risk. Diversification simply means spreading your money across many different investments. Don't just buy one stock. Buy several, ideally across different industries, maybe different countries too.
So if one company or even one whole sector has a terrible year,
It doesn't sink your entire ship. Your other investments in different areas might be doing fine or even great, balancing things out. It smooths out the ride and protects you from catastrophic loss if one specific bet goes wrong.
spreading the risk makes total sense. So how does an everyday person achieve this diversification easily? Buying 50 different stocks sounds like a lot of work and requires a lot of money.
It is a lot of work. And this is where investment funds become so incredibly useful, especially for beginners or anyone who doesn't want stock picking to be a full-time job.
You mean mutual funds, index funds, ETFs?
Exactly. These are pools of money from many investors that are used to buy a whole portfolio of stocks or bonds or other assets. When you buy one share of a fund, you're instantly buying tiny pieces of all the companies held within that fund.
Instant diversification.
Precisely. You can buy a fund that holds hundreds, even thousands of different stocks with a single transaction. It dramatically simplifies things and automatically spreads your risk.
What's the difference between them, quickly? Mutual funds, index funds, ETFs.
Mutual funds are often actively managed, meaning a manager tries to pick winning stocks and they're priced once a day. Index funds simply aim to track a market index, like the S&P 500, passively. They usually have lower fees because there's less active management. ETFs are similar to index funds in that many track an index, but they trade on exchanges throughout the day, like individual stocks.
So index funds and ETFs sound like great options for easy, low-cost diversification, like buying the whole haystack instead of searching for the needle.
Yeah, it's a fantastic way to put it. For most people, especially starting out, buying a broad market index fund or ETF is a very sensible, low-cost way to get diversified exposure to stock market growth over the long term. You can't invest directly in an index like the S&P 500, but you buy a fund that mirrors it. It aligns perfectly with that patient, diversified, long-term approach.
This has been honestly really clarifying, taking this big, scary topic of stocks and through this plebonomics lens, making it feel much more graspable.
Yeah, we covered a lot of ground, from what a stock actually is, that slice of ownership.
The piece of the pie.
Exactly. To why companies issue them, raising that crucial capital, often through an IPO. And the key difference between owning stock versus lending money via bonds.
And we broke down the main types. Common stock with its votes and variable dividends versus preferred stock with its fixed payments and higher priority, but usually no vote.
Then we dug into what you really get as an owner. The right to vote, potential dividends, those preemptive rights sometimes, and that critical safety net of limited liability. Plus, that little insight into the principal-agent dynamic.
And tackled the big question of price changes, that constant push and pull of supply and demand, swayed by company news, the economy, and yeah, even our own human emotions and biases, plus acknowledging the real risks involved.
And finally, the practical steps. Getting a brokerage account, understanding the difference between investing long-term versus short-term trading, and the absolute power of diversification, often made easy through funds like ETFs.
So, as everyone listening goes about their day now, maybe seeing news headlines or company logos.
Yeah.
What's the takeaway? How might you, the listener, see things differently now?
Yeah, when you look at a company, is it just a place you shop or a brand you know? Or do you now also see it as, well, a collection of shared opportunities, shared risk,
Yeah.
something people collectively own and have a stake in?
And thinking about that long history, from Roman shares to today's digital exchanges, how do you want to participate, if at all, in this ongoing story of shared enterprise and economic growth?
It's really about empowerment. Hopefully this conversation gives you a foundation to engage more confidently with financial news, with discussions about the economy, and maybe even take informed steps towards your own financial goals, whatever they may be.